Before you sit down to file your tax return, don't forget to check these 5 things. Welcome to TOI Wallet Talks. The income tax filing season is here, and in this week's episode, Surabhi Marwah, tax partner at EY, is going to help solve the top 5 most basic queries you may have when you set out to file your tax return. Hi Surabhi, welcome to the show.
Hi Smriti, thank you for having me.
Surabhi, so the tax filing season is here, and with this episode, we are actually looking to educate our viewers on very basic things like how do they arrive at their gross taxable, salary or income, and what is the annual information statement, which is the right ITR form for them. So that's the aim of the episode today, and we're hoping that by the end of this, people will know that when they start to file out, their tax returns, they're better informed and it's less tedious for them. So, Surabhi, the first question is, how do I arrive at my gross salary? How do I know what is my taxable income?
Okay, so it's very simple. What you need to do, and I'm going to keep it very simple, speak in layman language.
Right.
Add up everything that you're receiving. So all of your emoluments, all your allowances, your bonuses, everything needs to be added up first. After that, there's a 3-step approach. You need to subtract your eligible deductions. Okay, so first you look at things like what are my deductions and exemptions. For example, the Income Tax Act has an exemption for house rent allowance. Your LTA or your leave travel allowance may be considered as exempt in certain cases. Now, very often your employer, or in most cases your employer, while giving you your certificate of tax deducted at source, would have considered these. But if they haven't, then you should know that all of these have tax exemptions available. So that's one. Number 2, you should, all of us make investments, and we know that there's this section called ATC, etc., where you can claim deductions for certain investments made. So make sure that you claim those. There is something for ATC, there's something under ATCCD, which is for pension, etc. So 150 plus 50, you need to claim that. It doesn't automatically come in. The third thing that is very important is that you also have another section called ATD, where you can claim deductions again for things like medical insurances, etc., paid for yourself, your family. The good thing is that the form has these, all the income tax forms have these line items with say ATC, ATD, etc. So you are prompted. So it's not as if suddenly you have a blank piece of paper or an Excel. And after that, you would also need to key in things for provident fund and other things that, other employer-related investments you make for ease of understanding. After you subtract all of these things, you get to your net salary or your net taxable income. So there's a lot of difference between your gross and net.
Okay. And what is Form 16? What is Form 26 AIS? And what is the annual information statement?
Okay, so the Form 16 is your certificate of tax deducted at source. This is something that an employer, Form 16 is something an employer will give to an employee. Part is generated, part is keyed in, which will say this is the name of the employee, this is the amount of income in 4 quarters, and this is the amount of tax that they deducted. The Form 16 will also have, in many cases, your gross salary. They'll also show how the HRA and other, employer-related or salary-related exemptions have come in. So to that extent, a taxable amount of salary will be in the Form 16. So that's a good thing, that if you've given all your income or expenditure proofs to the employer, like you would be asked which regime you want to go opt for, or you would be asked in March of the year, please furnish all your investment proofs. So if you've given all the proofs that I just spoke about to your employer, all of these will appear in the Form 16. And typically, if everything is given, then the net taxable salary that is appearing in the Form 16 is the salary that you will consider for your tax return. 26 AS, it's a brilliant and very powerful source of information. The 26 AS is something that you as an individual can download. You go to the income tax portal, it says download for Form 26 AS. It basically gives you other than all and also the salary income. So it'll have several tabs. It'll say income from salary and tax. So you will see for Surabhi, EY, and then the income and the tax deducted. What have I got from banks? What have I got as dividend? What is the tax I may have deducted if I'm, if I'm a purchaser or seller of property, etc. the
Right.
TCS, for example, on this whole LRS question that is coming in. So it gives you a synopsis of all of the taxes deducted on all of your incomes and anything that you may have also deducted. Again, it can flow into your tax return form, but the form 16 was just salary. This is a overall synopsis of income and tax deducted at source. A lot of people ask, if everything is given in the 26 years, then why do I need this AIS, which is relatively newer than form 26 years? AIS is even more powerful because it gives you all your financial transactions like mutual fund redemption, share purchases, a lot of other things. And they can also flow into the tax return. So one has to be very careful that, there could be transactions on which taxes are not deducted, but those are reflected in the AIS. So very important to match your AIS with your tax return form, because, all the transactions may not be those that need tax deduction at source, but they could still be reflected as income. So they may not come in the 26 years, may or may not, but you need to add them. And the income tax authorities are fast looking at this AIS also as a means to reconcile that everything has been reported. 26 AS, if you don't report, automatically you will get a notification because the database is interlinked. And that, I understand, is also to happen or is happening for the AIS. So three things: form 16, employer will give you; 26 AS and AIS you need to download at the income tax portal, and mostly all of this flows into your tax return form if you're filing it online.
Okay, and what are the most common, sources of income that one can tend to forget in terms of reporting?
So I'll tell you the common forms. Some one forgets, some one doesn't. So the first is interest income. What we as individuals end up doing is we look at our 2 or 3 big banks and we know what is the income because we get the interest certificates. But all of us typically have bank accounts in various places and with smaller amounts. So one major account and then smaller amounts where we park a little bit of money. Please don't ignore the savings bank interest from there, because all of the banks you have will pop up somewhere, and then why miss out on interest income, which is even small interest income. Also on FD income, a lot of people will look at, how should I offer it for tax once the FD matures or on a year-on-year basis. That selection is done by you once to start with. So just make sure that you follow it consistently, and also see whether the form 26 AS is reflecting that interest income. Because if you think you're going to offer it for tax later, but the bank has deducted tax at source on it, better to offer it there, because otherwise you will have a mismatch thrown. So that's one of the things. One big one is deemed to be let out income. Now rentals, when we are getting rentals, when we let out our properties, we know we are getting the rentals, they're coming in our bank account. So there's very little you can't really miss it. And there's a way we compute rental income as well. But there is also a concept of deemed rental. So if I own 3 properties and none of them are let out, 2 is fine. I can earn 0 from them and nothing needs to be taxed. But on the 3rd, the government says, hey, if you wanted to let it out, you could have. So please, there is a deemed rental value you need to add, notional rent value that you need to add in your tax return form, and there is a complex formula on how to sort of get that value. But many people may say, all the 3 houses are empty, I'm not getting any real money, so nothing needs to be added. So remember, if there are 3 in your name, 2 are fine, you don't need to do anything. It used to be 1 earlier, now it's 2. But on the 3rd, 4th, whatever, you need to add that deemed or notional rent.
Okay.
Yeah, that's very important. Another one that people really miss out is income of minor child. Now, income of minor child has to be added into the income of one of the parents. There are again rules that if the child has earned it from his own profession or some skill, etc., and then it's a complex thing. I'm just trying to make it simple. Then of course it's the child's own income. But otherwise, in all cases, sometimes you open FDs for your children. You open, you may have other things, and you forget to include that minor income child because his or her bank account is reflected separately, so you may not get that certificate. Very, very common mistake. So please do inform your viewers that they need to take this into account. The 4th thing people forget is pension. Now we know about commuted, uncommuted pension. There's so much around EPS and pension going on. Don't forget your pension income, that needs to be added as well. Dividend is another one. Typically, again, it gets thrown out in the form 26 AS, so you should not miss it. But sometimes you have various demat accounts. You may have very small dividend amounts as well. Dividend is fully taxable. Many years ago, a few years ago, it used to be taxed in the hands of the companies and not individuals. We shouldn't forget that we still have to do it. So dividend income after a certain extent is taxable. So you need to add that in. Another very important one, you asked for 5, I'm giving you 6. When you switch from one mutual fund to another, and we do that a lot when we do our investment portfolio reviews, etc. Those are typically capital gains. So please don't forget that, because you thought I've switched from one to the other. Again, they should reflect in your bank, your portfolio statements that the banks, etc., give you as capital gains. But very often, people invest directly or on platforms like Zerodha, etc. So you may not get those statements of capital gain. I'm not sure if you do or you're not. If you do, great. But don't miss out on this one as well.
Okay. Any common relief and rebates that I should be aware of?
So the common ones, I think all of us know them, but I'll just kind of refresh it. ATC, which is your Provident Fund, LIC, that's 150. There is an additional amount you can invest in NPS. There's an additional 50,000 that you get. Don't forget that. ATD for medical. Remember, if there are different limits, if you are paying insurance premium for yourself and your spouse and children, and also for your parents. So it's a little extra if you're paying for your parents who are senior citizens. So get that limit right. Home loan interest and payment, section 24. Again, you get a deduction or an exemption of 2 lakh rupees. If it's more than 2 lakhs, you can take a carry forward. So don't forget that third part. Donations, people sometimes forget, that's under 80G. What is important is to see, and I would do it this way, is to see what are my sources of income, what are my various bank accounts, so that, and then just peruse them for, so bank accounts would have interest, demat accounts would have dividend. Look at minor children, look at all of these things. And for your deductions, look at all the investments that you make. People don't forget the ATC and the ATD, but they end up forgetting the other ones, which are also relevant.
So, Surabhi, now that we have our Form 16, 26 years, the AIS is there, and we've matched our sources of income. As a salaried individual, how do I decide which is the right income tax form for me? Is it ITR-1? Is it ITR-2?
So the ITR-1 is for a resident, and not a, so in India, resident is resident and ordinary resident, and a resident and not ordinary resident. Typically, most of us who are living here, who are not traveling in and out, are resident and ordinary resident. So for us, ITR-1 should apply. The income for ITR-1 should be up to 50 lakh rupees. That's most important. You can have income from salary, one house property, so the rental. You can have interest, you can have dividend, and you can have agricultural income up to 5,000 rupees. It's the simplest form, and 99.9% people fit into this form. Okay. The ITR-2 is, of course, if you have more than one rental property, or if you have capital gains, etc., then you file the ITR-2. So again, a lot of people end up filing that. But ITR-2 is only valid if you don't have income from a business or profession. So for example, a consultant will not file an ITR-2 because that comes as professional income. So I'll tell you, the common thing I would say is, did you have any capital gain in the year? Even if a little bit, sorry, ITR-2 for you. If it's just salary, one house property and interest, a lot of people starting up, or a lot of people who are not doing a lot of redemptions given the markets right now, ITR-1. So that is how you should kind of look at it and, choose the right file.
But even if my capital gains are less than 1 lakh rupees, I should still file ITR-2.
So very good question, Smriti, because a lot of people would think no income from capital gains, so ITR-1. No, it is ITR-2, because all of these are specific exemptions given. So you have to report them and then get the exemption, and therefore it is ITR-2. So the character of income is what's important. Whether you have exempt capital gains or a little amount of capital gains, you still have to do ITR-2. It's a bit more complex than ITR-1, more fields required, but that's the way the income tax authorities have set out.